much for joining us, Carol Sadler, for another edition of Your Business Unleashed podcast. Today, we're going to be talking about the underused housing tax. And I figured who better to have on the podcast than my business partner, Carol Sadler, who is our cross-border and U.S. tax specialist and has been at it for quite a while. But I'll leave that to you, Carol. Please give us your intro and tell us a little bit about your past.
I'm both a CPA in Canada and a CPA in the US. I'm licensed for all parts of the United States. And I've also done a lot of work in the trust and estates area with a group called STEP, Society of Trust and Estate Practitioners.
You've been volunteering with them for quite a while, haven't you?
I have, and it's really exciting. I've been deputy chair for a bit of time, and I'll take the chairpersonship this May, and it's gonna be really exciting. It gives us access to a lot of great talent across the country.
Yeah, fabulous. And before we met you, how long have we been together now? 6 years or so?
Seven going on 8, actually. Yeah, time flies
when you're having fun.
Mm-hmm.
And before that, I think you'd been at cross-border tax for quite a few years, right?
Quite a few years, yes. As I'd left the cross-border U.S. group at Deloitte's and for my own firm, which was Sadler Tax Advisors, and that's what I did there for many moons while kids grew up and went through university. We'll leave it at that.
All right, sounds good. Needless to say, anything that crosses the border, including, the intended target, I think, of this underused housing tax, or the stated intended target, I should say, that's definitely an area that is of interest to you, right? So, I thought maybe we'd just chat a second about, so what is this underused housing tax, and why is LinkedIn and everywhere blowing up with it right now? Why does this matter so much? So, just to start, it's a tax on vacant or underused property that came into effect Jan 1, 2022. The funny part about that is we didn't know about it, on January 1, 2022, did we, Carol?
No, the actual legislation was not passed until end of June, and forms were only available, a couple months ago, I think even less than that.
When are the first returns due on this one? So if it starts on January 1, 2022, what's my obligation to file?
Your obligation covers the calendar year, and you've got to file that form by April 30th.
Right. So it is now mid-February. This podcast probably won't be published for another week. And so you've got basically 2 months left to put everything together and get this filing in. And what happens if you don't? What happens if you don't file this and you should have?
The difficulty is there's a penalty for failing to file the return on time. Individuals will face a penalty of at least $5,000. Corporations will face a penalty of $10,000. And that's simply for not filing the form. And the tough part about it is a form is required in many cases, even if you don't owe the tax. There's still reporting that must happen.
Right. So we're going to get into that actually and get through, there's sort of two steps. One, do you have to file the form? But then two, are you exempt from the tax even if you have to file the form? We're going to go there. But maybe if you could let's talk for a second about why is there an underused housing tax? Why is this happening in Canada right now?
The theory is this is an effort to cool the hot real estate market in Canada. Affordability in housing has been an issue for the last while, and the government has been thinking that relates at least partly to foreign buyers buying and holding real estate for gains, and therefore the underused part of the tax. There's been purchases of housing that's essentially being taken off the market because people are speculating.
Right. And so now we've got a situation where people need housing and there's a shortage of housing because there's housing sitting empty or underused, on which investors are hoping to have a gain. And in many cases, they are claiming their principal residence exemption on it. We saw the government go after that back in 2016, where we had to start reporting the dispositions of our principal residences, even though they may not trigger tax, but that is reportable now, starting in 2016. Now there's an actual tax on property sitting empty. And so Yeah, that's super interesting. And so how is this tax so again, we come back to, do I have to report the form? We're going to get into that in a second. Do I have to file the return? But then do I have to pay the tax? So let's assume that you do have to pay the tax. Let's jump right there. How is this calculated?
1% of the property's assessed value for property tax. So I should step back and say, step one is, do you own that property at December 31st? If so,
Okay, let's drill into that for a second because that's relevant. What do you mean by own the property? What is the specific bright line? As I understand it, it has to do with title.
absolutely right. Are
Okay,
you on legal title?
right. Okay. So
That
we're on legal
that's the
title,
break line test.
right? And it doesn't matter if it's a corp or if you're a partner in a partnership or a trustee in a trust or an individual, it's the owner on title that matters here, right?
Correct. Absolutely correct.
Okay. And so the value is 1% of the assessed value, or I think the most recent sale price, which would dictate sort of fair value, or you can get an appraisal of fair value. And so, I think that there's going to be some specific, or there are some specific rules about how appraisers are to determine fair value with in line with this legislation as well. And we're not going to talk about that here. So, effectively, let's just call it 1% of the fair value of the house, whether that's assessed value, most recent sale price, or an appraised value through a professional appraiser. I guess, is this the same if I live in Vancouver and there's a vacancy tax? Is that the same thing, or is this a substitute for that?
It's an addition to. So you're right. Vancouver has a vacancy tax. I believe Toronto has introduced one recently. I think there's a tax that applies to all of BC. And
Or a
this
good part of
now,
it, yeah.
yeah,
Right.
and this is now an additional tax, a federal tax. So
this is an and.
this is an
You're paying
and, not
both
an or.
potentially. Okay.
It's an and.
Okay, so I'm really surprised, and I think the LinkedIn and professional communities are freaking out right now over this, for good reason. The government had originally said that this was going to target non-residents. So, for example, somebody from a different country coming in, buying a property, sitting on it vacant, hoping that it'll make a gain, as our properties in Canada have often done for the last, as long as I can remember. And that was the stated target of this, but that isn't really the case, is it?
That's the difficulty, Clayton, for sure. And you're totally right. That was the theory, is that this would be a tax aimed at non-residents. And it certainly is applicable to individuals who are not Canadian citizens or permanent residents. However, certain corporations, many trusts, and many partnerships will have to file the return whether they owe tax or not. So the filing scope is huge.
The filing scope is huge, and the return, I think, I don't want to say it's simple because there's always nuances, but if we look at, so that there's this idea of excluded owner. So who are you if you're an excluded owner? And so you can be an individual who's a Canadian citizen or a permanent resident. Great. So if I, Clayton, own individually now, let's not talk about joint ownership with my spouse, because that's a whole other issue. But if I own a second property, and I'm renting it or whatever, because I'm a Canadian citizen and a permanent resident and I own it directly, I should be fine in not having to file this. Check with your tax advisor, or you can see the article on our website, of course, for more details. But let's say, for example, that I own my share in the property or the property in whole as a partner of a partnership, which, by the way, when it comes to for-profit ventures, I am in a partnership with my wife. Whether or not we have a partnership agreement, that is a partnership. If there's a profit motivation there and we're in business to do something, that is a partnership. Or through a trustee in a trust. So maybe mom left us the vacation property up in Red Deer and threw it into a trust, so that it could be free from probate as part of her estate planning way back in the day. And it's sitting in a trust and I'm a trustee of that trust. Now we're caught under these rules. Or how about if I have a Canadian controlled private corporation, as most business owners do, or any other kind of Canadian private company, and that owns my rental property or my Airbnb. Now we're caught as well. Those are all like really surprising scenarios that I found as we started to go through these rules, of folks that or owners that need to file this return. So you can't just go, listen, I'm not a non, I'm a resident of Canada and I'm good. Well, you start to go, well, wait a minute. I'm in a partnership with my wife. We have an Airbnb, and clearly it's a for-profit venture. That's why we're in the Airbnb game. And so
Mhm.
now that's owned through a partnership, and therefore we have to file this thing. I'm not just simply exempt because we're Canadian citizens or residents. Right? Am I right on that?
Correct. You've got it. And I like the approach that you've taken. And that's the way I like to think about it. There are excluded owners who are not required to file the return. Uh, but what I find is other than Canadian citizen individuals, the excluded owner list is really quite esoteric and quite specific. So I really like what you've done to turn around and say these other entities must file the UHT returns, except the private corporations, foreign corporations. You've gone through them, trustees of trusts, partners of partnerships, even if you're an individual. Um, uh,
Well,
some
and I think
people oh, go ahead.
let's wrap on
Mhm.
that
Yeah.
trustees of a trust thing for a second.
Okay.
Like let's park it there. No, everybody goes, okay, the Achen Family Trust, right? I'm a trustee of that, and that's a pretty easy one to catch. Mom left me the vacation property for me and my siblings to enjoy up in Red Deer, and it's in the Achen Family Trust. Well, that one's easy. How about where trusts are unintentionally created or maybe intentionally created, but you're not thinking of it as a like an inter vivos family trust? There's a lot of other scenarios. For example, I'm not sure if you've recently co-signed it because I know you have a pile of kids. Like Carol's got 9 or 10 kids, I think. Is it or
Only
just
half that.
only half? Well, four. Okay. So I'm not sure if any of them have asked you to co-sign on their mortgages yet, but would that make you, I mean, that would put you directly on title.
It would. Now, you're right. Personally, and thank goodness, I haven't had to do that. But we have clients who are in that situation, where mom and dad have been required not only to co-sign the mortgage, but to be on title.
To be on title.
And I
And now
think
you're a
that
trustee,
I
right?
think
Because
now
that's the
you're a
kid's
trustee.
property.
Yeah.
You legally hold the title, but the
Mhm.
beneficial owner is the kid. Therefore, a trust is
Yeah.
created, whether or not you thought of that,
Correct. Correct.
right?
It's important, I think, to think here that, as you've been saying, we can expand on this more. As opposed to, say, a corporation where one thinks of having the legal documents to create this corporation, partnerships and trust are created essentially by operation of law. They exist whether you wrote a formal document or didn't write a formal document. The
Right.
question is, what is that? What is that relationship? And I think it's wise to err on, because of the penalties being so huge, it's wise to err on the side of this might be a trust relationship. We better file.
Right. I mean, and so if we extend that out, another one that we commonly see, particularly with yours and mine's involvement with STEP and the Society of Trust Estate Practitioners, we commonly see other family members being added to title with or without a right of survivorship in order to avoid probate or avoid estate issues and to basically
Mhm.
have a direct transfer of real property upon death of mom or dad or whoever. And so we've got all these people who are on title who have that's inadvertently created a trust and very likely a reporting requirement under the underused housing tax. Am I right on that as well?
Correct. That's a concern for sure.
So that's I mean, this is really wide sweeping. I mean, if I'm going, Erica and I have a vacation property in Fernie, which I hope one day is coming up. Now we really need to look at the substance of that vacation property. Is it an Airbnb that I'm in the business with my spouse to earn a profit from, and we're both on title? Because remember, it comes down to who's on title. And if we are
Indeed.
both on title and there is a profit intention, very likely we have to fill this form. So I guess the same would follow if we just had a rental property, for example, and we'd been putting it on our personal tax returns. I mean, clearly you've got the rental property to earn income from. Otherwise, why would you invest your capital that way? So, I guess there are scenarios where you are in a co-ownership position, which would be sort of not a partnership where you don't have a profit intention and you're just on as co-owners. And perhaps that would be the vacation property that I don't intend to rent out. Or if I do intend to rent out, maybe it's just to cover some costs and not to actually earn a profit. So there's a shade of gray in there that you need to analyze on a case by case basis. But basically any property that isn't the one that you're living in, you got to have a real hard look at whether or not you need to be filing this return.
Agreed.
Okay, so I'm the resident Canadian guy, and I've talked about resident Canadian issues. Let's talk about this from a non-resident standpoint. So I'm going to shut up now because you're way better at this stuff than I am. So who has to file, and what's the scenario that they have to file the underused housing tax form?
The first group that comes to mind are non-Canadian citizens, non-permanent residents. So that, and I can think of a couple different groups of folks who fall into those categories. One that I think was perhaps not intended, but still caught are, and we've clients and customers in this area, are people who are in Canada on work visas because they're not Canadian citizens or permanent residents. I bet in a lot of cases they're hoping
so they've
to
bought
be,
a house,
but they're not, and they've bought a house, and they're not an excluded owner. And there may be some outs from the tax that we can talk about later on, but they're probably going to have to file. So people here on work visas, definitely the non-residents, non-citizens. So someone from Arizona decides they don't like the heat in the summer and they buy a place up in Edmonton or Calgary or Fernie or wherever to use as a vacation place. Sure. I think there's a lot of that happening. There's a lot more worry on the East Coast where there are a lot of folks who have vacation properties in Quebec and Ontario.
I was just in Revelstoke skiing with my family for the long weekend, and I bet you that a pile of those mansions on the side of the hill are owned by non-residents.
Yeah.
And so they would be caught.
They would be caught. They've got to file.
Yeah,
interesting. And that's interesting because I don't know that a lot of those folks would have a lot of connection to the Canadian tax system otherwise, unless they're renting, perhaps. But simply as on the requirement to file, you're an individual who's not a Canadian citizen. You've got to file, and then should they hold it through a corporation, trust, or partnership, we've talked about those options as well.
Okay, so you have to file. You've determined that you have to file. We've got an online checklist, but you got to be careful with these online checklists. I mean, they don't catch every scenario, or maybe they do catch every scenario, but a specific circumstance which you are a party to doesn't click to you in your brain. For example, I'm married to my business partner. We have an Airbnb, therefore we hold our interest through a partnership. Like, that's not something you would think of when you're filling out, do I need to file this thing? Well, yes, you do, but you might not think of that, right? And so you have to file. Now, who has to pay? So it's basically, as I understand it, the way that the legislation is worded is basically everybody has to pay, except for if you fall under an exemption. So, the way the act reads is you must pay tax unless you're exempt. So it starts off with everybody pays tax unless you can find an exemption. So now you start going through the exemptions. There's 3 different types of exemptions. The first is the type of owner. The second is the availability of the property. And the third is the occupancy of the property. Let's talk about the type of owner. So if you are a specified Canadian corporation, you don't have to file. Okay. And so this is a type of owner number 1. So this would be if I had a Canadian company, Canadian controlled private company, just like most of our entrepreneur clients, but it could be more than that, by the way. Anything we're talking here is just examples. Mm-hmm. My Canadian controlled private company owns an Airbnb or a rental company, and I'm a Canadian resident, and so foreign owners don't own 10% of more of the corporation, therefore you're exempt from the tax. So you're good. You still have to file the form though, right? Remember that. All these examples, you still have to file the form, you're just not paying the tax. So that's the first one. The second one is basically the same thing, but in a specified Canadian partnership. So let's say Achen Henderson LLP, which is owned by 3 Canadian controlled private corporation PCs, owns a vacation property that we send our team to vacation in. Wouldn't that be nice? or we rent, and then in the spare time we rent it out as an Airbnb, whatever. That would also be exempt from paying the tax. Canadian trust as well, where each beneficiary is either an excluded owner or a specified Canadian corporation. So where beneficiaries of the trusts are Canadian corporations, this one gets a bit tricky. Talk to your tax advisor. Let's say you bought the property during the year and you didn't own it in any of the prior 9 years. You don't have to file it. So that's one where if you just bought your rental property this year or your Airbnb this year, you don't have to worry about filing the tax for this year, provided you didn't own that same property in any of the last 9 years. How about when the owner died? So if the owner died in this year or in the prior year, you don't have to file it. And then a personal representative of that person, also, they would go on title. Presumably when the person dies, the executor picks up title to everything until they can distribute it. That person is also exempt from having to pay. Remember, still have to file, don't have to pay. And then a co-owner, where the property was held with another co-owner who died, and they owned at least 25% of the property in the year of death or in the subsequent year. You're exempt in that scenario. So there are some type of owner exemptions that you get out of. Why don't you talk about the availability of the property exemptions, Carol, and try and keep it in simple language for us lay folk over here.
Okay, that's actually a tall order with those availability of property rules. Honestly, though, these rules apply to property under development, things being constructed. So I would say you and as you mentioned before, you only have to meet any one of those exemptions. So
sure, thank you for pointing that out.
If you've got, because a lot of us were worried about the effects on builders in Canada, but I think if you've got a specified Canadian corporation, owners more than 90% or more, you're exempt. Don't have to go on to availability of the property.
But let's park it there for a second. So I think what you're saying is if you're a builder who holds residential real estate as inventory and turns out residential houses, you've potentially got to file one of these returns for every one of those pieces of inventory that you have, although you may not have to pay the tax.
True. That very well may. Now that's a really good point. You won't have to pay the tax because the corporation meets the exemption. But you're right. You still have to file. You still have to report that property. So you're right. This is where the availability rules will come in. If the property is under construction and not substantially completed before April of the year. So in this case, for 2022, the property wasn't substantially completed before April which means by the end of March of 2022, don't have to report that property.
I think it's by April 30th.
We can, yeah, let's check that. April 30th is a filing deadline. I thought the under construction it was not substantially completed before April. I'm not sure in the date.
Oh, before April 1st. Okay,
yeah,
all right.
So that's I may be being cautious there, Clayton, but that was in the back of my mind. Because another rule says that if the construction was substantially completed between January 1st and March 31st, which is where I'm going with the pre-April, and the property is essentially put for sale to the public and was never occupied by anyone during the year. So we have the under construction and not completed by March 31st, April 1st. Second scenario, I have my corporation has property. I completed the condos or the standalone houses by March 31st, and they're now offered to the public, but they've not been sold. They've never been occupied by an individual. So I'm not one of the builders who moves into their show home. Okay. Also, again, exempt. There's another exemption for property that's not suitable to be lived in year-round or seasonally inaccessible. So I'm thinking perhaps of the unheated cottage on an island in the Muskokas, which is what I'd love, but
yeah,
kind of in the same list
that's a great example.
Cottage,
actually, my friend actually had us out to the Muskokas a couple summers ago, and they have one of these deals where it's 12 volt. You got a 4x4 in. It's 12 volt to run off the battery and for the lights. There's an outhouse out back. I mean, they're not getting here for half the year at least. So this would be one of those ones that it's not accessible all year, right? So.
Mhm. And then there's also a couple other exceptions for properties that are uninhabitable due to a disaster or some sort of hazardous condition. So tornado comes through and takes off your roof, and it takes a while to build it again. Some other natural disaster happens, or only once every 10 years, the property is uninhabitable for at least 120 days in the year due to ongoing major renovations. So I think I was sharing with you, I just renovated our house. So let's say this was a rent instead of my own house. It was a rental I had, and we torn out the kitchen and the bathrooms all together, and I was uninhabitable for at least 120 days. So my builder's taken more than 3 or 4 months to get things together.
Okay.
I've got
Yeah.
one exemption. So
And you can only do
a
that
rent
every
exemption.
10 years, right?
Once every 10 years. So rent was only every 10 years, folks.
Okay, so there's a few scenarios under the availability. Now the occupancy. So if the occupancy is the primary residence of the individual, their spouse, common law partner, or child attending a designated learning institution, you're good, you're out. And so that means if you
Yeah.
one of your really close family members, really close, is living in there, you're good. Note that they use the word primary, and that's not the same as principal. We talked about the principal residence exemption. This isn't the same thing at all. They use the GST rules to actually determine if a residence is a primary place of residence for the underused housing tax. So that's really interesting to note, because you can be away. You can physically be away. Physical occupancy isn't necessarily required, right? And so to determine a primary residence, and so that's important to keep in mind. And on that vein, if the property is continuously occupied for at least 1 month and 180 days in total and there's a list of individuals, it's basically family members, really close family members, and again, it doesn't require physical occupancy. It just means that it couldn't be available to anybody else, and that was their house. If they were off on vacation, that would still count in the days. And then the last exception is a vacation property that the owner or their spouse uses for 28 days in the year. So again, my vacation property that I rent out for, and I would like to make money off of my Airbnb, perhaps I'm a non-resident of Canada, and so I have to file the form. But if I've got my vacation property in Revelstoke and I'm there at least 28 days a year, does that mean I'm good as a non-resident and paying the tax? I don't have to pay the tax, Carol?
I think just a month is not going to cut it, because that may be not enough to make it a primary place of residence, and the continuously occupying the property test is for at least a month for a total of at least 180 days in the year. So I mean that to me would be a concern, that someone's using their property 3 or 4 months a year, and they're not there at least a month at a time, and they're not there for at least 180 days in the year. I'd say they don't get that exemption.
Interesting. Mm-hmm. So another scenario here is that if you are renting and you're doing it to a unrelated third party, so as in not a family member, under a written agreement, you're good. So this is even if you're a non-resident, right? So you don't qualify under the citizen or permanent residence exemption. You're not in a Canadian corp, or maybe you are in a Canadian corp, or a foreign corp rather. But you can get out if you're actually renting the property. So this is not from filing. This is from paying the tax. Is that right?
That's correct. Filing obligation, but one of the exemptions from paying the tax is you've got an unrelated person occupying the property for at least a month, so month-to-month type or longer type term leases for at least 180 days in the year, half the year. So we've got, as I said, for example, we've got someone from the US, owns a condo up here in Canada, rents it to an arm's length, rents at arm's length. It's their rental property. They're exempt from the tax because they've got.
So what if it's to a family member?
Now there is the difficulty. You also need a written agreement. However, the family member has to pay a rent that's what's called a fair rent. So the family
Okay.
member needs to pay.
What is fair rent to a family member? I mean, I think $10 a month is fair to my mummy. She, I love my mummy. So,
Yeah,
right? $10 a
yeah.
month. Does that fly?
No, it doesn't. And
Oh,
surprisingly, a market value type rent, hey, the property next door has been renting for $1,000 a month, may not cut it either because the law requires a fair rent to be at least 5% of the value of the property. So if you got a fair value
5% of the
of
value of a
yeah,
property. So what do you think $500,000 gets you in Red Deer?
it would probably get you a decent little condo or probably a nice decent little house.
And do you
But
think you'd
five
be able to rent that for $2,100 a month on the open market? Probably not.
Probably not. No, exactly.
Probably
And you
not.
actually, yeah. And you need probably something for for 5% of a $500,000 uh rent. Yeah, you're right.
2,100
2,100 and
bucks a
2,100
month.
is what you're going to need. Absolutely. Good math,
And
Clayton.
so
Yeah.
let me get this straight. So fair rent to the government is me renting my house to my brother or mummy for
Mhm.
more. I have to rent it for according to the calculation. It's not actually fair. It's just defined as fair. It's a defined term that says you have to rent it for probably more than you could go and rent it to somebody you didn't know. And if you didn't, then you're not exempt and you have to pay this 1% underused housing tax. Is that right?
That's what we're reading, Clayton. Yeah. And surprisingly, there's not been a lot of commentary from the tax authorities on that.
Interesting. Interesting. So watch your related party rental agreements, folks. You could end up in a world of hurt if you don't qualify under one of the exemptions, one of the other exemptions. Remember, we're probably talking about a foreign individual who owns a rental property, renting it to a kid who's attending university, for example. I mean, this is where we could get into trouble, right? If it's not happening at what the government says is fair value, which is not actually fair rent. It's if we were to go out and fetch rent in the market, it's a calculated number. It's just a clever word that they're using, fair rent, and it's a defined term. You might be caught under this, right? So
Agreed. That's a concern we've got and we've been seeing.
okay, well, I think that's pretty much it. I think we've gone through. We've got a bunch of. First of all, I guess we should say that there's going to be a blog linked into the show notes here where you can go and read about everything we've just talked about. I've also included some surprising scenarios on who might have to file a UHT return that we weren't expecting when this was first announced. And remember, if you don't file this, you do so at your own peril. It's $5,000 penalty for an individual, 10,000 if it's in a Canadian controlled corporation or another kind of corporation, $10,000 penalty for corps. And so we would be happy to go through and chat with you about whether or not you need to file a UHT return. We've got a checklist on where you can go through and fill out the checklist and see if you have to, and then a bunch of references available in our blog. I don't think that we're able to file these things on behalf of people yet through our rep ID yet, are we, Carol?
Not that I'm aware of, no. And there are still some questions as to whether those returns can be e-filed at all, and or whether they can now be mailed in. And so definitely can print off a paper return and mail it in. My understanding is e-file was going to be available, but no news yet. That's a stay tuned question.
Fabulous. Well, thank you so much, Carol. I appreciate you making the time. Scary stuff, scary stuff, and very wide ranging. So if anybody would like to chat with Carol or me about whether or not you need to complete an underused housing tax return, please feel free to reach out via our website at achenhenderson.ca. Thank you so much, Carol, for joining me today.
You're welcome.